Good afternoon, and welcome to the Midday Market Update on December 8th. I'm Michael Vincent, and I'm joined today by Zach Strickland.
Yep, filling in for Mr. Hill again, who is on perpetual vacation.
Perpetual vacation. Oh, awesome, man. Hey, we got a great show today. It is an interactive show, so get your comments and questions in on FreightWaves LinkedIn and Facebook channels, and we'll get them addressed or answered as best we possibly can. We got a great show, though, today. We got, who do we have? Kyle Lintner, right?
Kyle Lintner. K-Ratio.
From K-Ratio is
Kyle.
Yeah.
Got a lot to talk about with him. What's going on in today's market and what he's seeing, et cetera. And Greg Miller.
Yeah, Greg Miller. He's got some interesting thing about flexi tanks and wine and...
Yeah, I'm really curious to see what that is.
Yeah, me too.
But also, of course, the maritime update as well to see what he's going to have to say about the Trans-Pacific, but also what's going on the East Coast as well.
Yeah, right, because it's not just the west side of the United States.
We have two sides.
There are two coasts.
Two coasts.
Right.
The East and West Coast, and we'll talk about both with him.
We will. We will. When I was growing up in Cleveland, we called it the North Coast of America, but that's not really true.
Lake Erie shipping.
Yeah, it's huge. It's huge. The Lake Erie Maritime Update with Greg Miller. No, we're not going to do that. But who we do have in the house today is Andrew Cox.
Andrew Cox here to give us the what's happening in today's stories, right?
Absolutely. Andrew, how are you doing today, my friend?
I'm good, guys. Glad to be back. I'll start off with one about Trevor Milton and Nikola. Last week, there was a huge lockup period that expired for the early buyers of Nikola stock. The big question surrounded what would Trevor Milton do with his 91 million shares, and the answer so far is not much, at least for now. Milton sold about 3 million shares on Friday, 3 days after the lockup period ended. He remains by far the company's largest shareholder with 88 million shares. Nikola's stock price fell about 14% on Tuesday, that first day that the lockup period expired, with about double the normal trading volume, so you can see that some shares exchanged hands from early buyers. Milton sold the majority of his 3 million shares on Friday at a price of $18.98. That's down from more than $50 a share one day before that scathing Hindenburg report came out that eventually ousted Milton from the company.
Yeah, I don't think this is insanely shocking, considering he's probably just going to further remove himself from his company, don't you think?
Yeah, he cashed out a cool $52 million or something.
Yeah, I mean, Andrew, do you think this is just simply him saying, I don't really want to be a part of this anymore and moving on?
I think this is him cashing in a little bit of money, getting some liquid assets right now. But I would see that he could probably just hold on to some shares for a little bit. The stock has traded very violently over the past few months. We've seen it double from 18 to 36 in recent weeks, and now it's pulled back again now to the low 20s. So, yeah, I mean, I think he's going to just kind of roll these out and sell shares periodically throughout the next couple of years. I don't see him taking a bigger role with the company moving forward.
So the one thing, Andrew, that I had a question for you, maybe you have an answer, maybe not, is the 4 million shares that took, Robert Bosch down to less than 5%. He's a fuel cell supplier, is that right, a partner or vendor or something? Does that tell us anything or no?
I mean, if you're a Nikola investor, then it maybe should tell you that the original buyers of the company, the people that had the most confidence in the company back a few months ago, are now kind of losing confidence and trying to reduce their market value of their company. So it should be a little bit scary if you're a Nikola investor.
Yeah, so it is a confidence indicator that you need to look at, I guess.
Yeah, I certainly think so. I think it's a loss in confidence, and that's certainly not a confidence boost to anybody holding in KLA at the moment.
Interesting. So what else we got in the headlines?
So we got Zach's favorite company, YRC, worldwide, up next. The LTL carrier reported Monday that shipments were flat year over year for the first 2 months of the quarter, with revenue per shipment up slightly, about 30 basis points year over year. The trends are improving at YRC, but at a slower pace than its competitors. Tonnage increased 1.9% year over year in October and was up 2.2% in November. ODFL, Old Dominion, noted tonnage increases of 2.2% in October and 5.2% in November. Saia, another huge competitor in the LTL market, said that results were even stronger, reporting tonnage increases of 5.7% and 7.3% respectively. YRC's yield, or tonnage per hundredweight, fell about 3.5% year over year in October, but improved slightly, up 60 basis points in November. By comparison, the yield for Old Dominion was 50 basis points higher year over year in October and up 3.8% in November. 2021 does look promising for YRC and the LTL carriers as a whole. There may be a rising tide lifts all boats scenario here, with the industrial segment poised for growth next year. The ISM PMI rose for the 6th straight month in November. Manufacturing activity can now represent more than 80% of total tonnage for some LTL carriers. And now on Thursday, there is a congressional there's a congressional committee hearing over serious concerns with the National Security Loan Program and that $700 million loan relief that was made to YRC. Treasury Secretary Steven Mnuchin is expected to testify, so we'll be covering that in depth, I'm sure, on Thursday, so stay tuned for updates on that hearing.
Mm-hmm. Do we have any indication what those serious concerns are on this?
I'm not exactly sure. I think there's just a lot of questions from people on the committee. I mean, just look at the YRC loan, for example. I mean, they gave them a $700 million loan when the company was only valued at about $300 million at the time. So I just think there's some more questions to be answered about how that money will be spent moving forward. I don't know what the impact was going to be, if there's going to be any clawing back of that money or anything like that. But I think there's just some questions to work through.
Gotcha.
Yeah, I don't know. I mean, they should have asked those questions before.
You would think,
in my opinion. But, maybe they're getting a little bit of a buyer's remorse there. I don't. The fact that YRC really hasn't been posting strong results for a while now would be my number one red flag. I mean, what is this? So they get $700 million to get back to square because of COVID, and of course they have the involvement with the government.
Was the $700 million to get them back to square because of COVID, or $700 million to get them back to square because they couldn't run the company before COVID?
Well, that's the thing, is they couldn't run it before COVID profitably. And now, I think the reasoning was that, back in April and May, there was such a threat to
national security
because they haul freight for the Defense Department.
Right.
That they needed to make sure that they were able to sustain it. And this was, of course, before the volumes had recovered to any significant amount.
Yeah.
And to me, it's kind of like, okay, I'm giving you money. I want to know what you're doing with it. And I think they just purchased a bunch of trucks with it, did they not? Or equipment, Andrew?
They did, yeah. That was one of the things that I've read coming out of that $700 million, that's what some of the money would be used for, was updating the fleet for YRC. And I do believe they've made some considerable investments in new fleets.
Yeah, their trends have improved, but not as much as everybody else. Are we looking at this like we looked at earnings earlier in the year in the truckload side of it, where if you didn't crush your earnings projections, then you were just you weren't doing a very good job at all? Are we reading this the same way, kind of?
I mean, that's how I'm reading it, right? Is that things are improving. We see what was a yield, tonnage was up 1.9%, but you look at tonnage up for Saia and ODFL, they're up a multiple of that. So I just think the U.S. government is probably just questioning, why are you getting outpaced by competitors, and what can we do with that $700 million to try to, get a return on our investment, so to say.
But they were already getting outpaced by their competitors, so this isn't like a new development in my mind. This was, you gave us money to sustain what we were doing, and thanks for that. But it's not like they're going to start breaking records now like that. I don't know I guess these are the questions that they're going to ask them coming up, is what did you think that was going to happen with the $700 million? What did YRC say was going to occur, and what did the government ask in return?
Right. Yeah, that's exactly. I mean, you look at this, and even their yield. Okay. But, so it only fell, 2.9% for the quarter, I guess, if you average that out.
Yeah, well, I mean, I think it's a fair comparison, because you have Old Dominion, who's kind of the industry benchmark for outperforming everybody, and then you have Saia, who's kind of in the middle of the road, solid carrier, but they're blowing their doors off.
Yeah.
YRC has been this, industry antiquity for a while. Just kind of hanging on. One of the longest running, companies in that sector, and they haven't really changed that much.
No. It's a behemoth to try and change that thing. It's
the infrastructure. Small. Yeah, the infrastructure there to move that would be a challenge.
Absolutely. Andrew, what's going on in reverse logistics these days?
Well, a lot. We've got real estate services giant CBRE released a report today that states the country will need to add 400 million square foot of warehouse capacity to meet and manage the increased reverse logistics needs of the industry. CBRE said that most of the square footage to handle returns will come from older distribution centers, which 3PLs and large retailers will vacate in favor of newer facilities to support forward logistics operations. As of April, there was about 10 billion square footage of industrial space dedicated to warehousing and distribution, said CBRE, and they also expect another 1.5 billion square foot of new logistics space footage to be added by 2025. Shoppers' reluctance to buy goods in person will result, and already has resulted, in record-shattering e-commerce sales so far this year, but that subsequently means record-shattering reverse logistics and reverse logistics costs as well. So despite the expected surge in returns, CBRE does believe that the supply chain, the reverse supply chain, should have enough transportation and warehouse capacity to effectively manage the process this year. That said, retailers and manufacturers are in a tough spot when it comes to managing returns. Reverse logistics costs, which consist of transportation, processing, discount loss, and liquidation loss, as well as the customer support through it all, can conservatively amount to about 60% of the retail price of a $50 item, says reverse logistics operator Optoro. Yet, a seamless returns process has become a top priority among online consumers. A recent survey said 42% of consumers would not use a retailer again if they suffer what they consider to be a poor returns process. And at the same time, 90% of respondents said that a positive experience would persuade them to use the retailer again. So it's a very important piece of the supply chain that retailers and transportation providers both need to focus on.
I mean, yeah, of course. But you remember back in the day, I mean, returns were low priority shipping items.
Oh, yeah.
Low service. So I guess that's why they need these, they're going to utilize these older warehouse spaces. They're going to transition those from being, those DC type spaces that have been worn down, where freight can sit for longer periods of time, versus the fulfillment centers and the forward-facing freight that goes out to the customers and their normal distribution channels. Is that what you think here?
Yeah, I was just going to say,
either one.
In the article, they wrote that these Class B facilities are actually much better suited for reverse logistics. They have lower ceilings. Typically, reverse logistics aren't trying to pile pallets up high, and as well as you said, things can sit there. They don't have to move as quickly. So these facilities are actually set up in a much better way to handle reverse logistics than the new Tier 1 massive warehouses.
My thoughts on that are that it's a dangerous slope to look at it the way you guys are looking at it. I'm not saying you're wrong. I think you're right, but it's the new age is they've got to figure out what to do with these things, because there's a tremendous loss in revenue here that could happen by looking at returns in the traditional sense of, well, they can sit there, who cares?
Agreed.
You know what I'm saying?
Yeah, for sure.
So figuring out how to effectively process those and get as much revenue out of them as you possibly can, I think there's going to be, obviously there's new tech and new players in that. It opens up the door for new players in that space to come in and help. And thrive, really, because I think there's tremendous opportunity, both positive and negative there.
Yeah, I think you're spot on. I mean, if you look at freight, the return freight as we traditionally did in the past, I mean, we basically sat on it for forever and just let it meander around the country until it got back to where it needed to go. You can't do that anymore, especially with the amount of freight, coming back nowadays.
Yeah, excellent. Thank you, Andrew, for those headlines. Always interesting, and we'll see you again on Thursday, I guess. The reverse logistics is something that has always intrigued me before. Just dealing with it in our former life.
Right.
The returns was not easy to deal with. They did, the companies, the shippers, the original shippers really didn't want much to deal with them. And I've been finding that lately in a personal level.
Sure.
Where we've had returns where people are just like,
just keep it.
Just keep it.
Yeah.
Just send me a picture or here, we're just sending you a new one. And what do you want to do with this? I don't care what you do with it.
Well, you think about why that is. I mean, think about it from our old life's perspective. To have a truck go back around and pick that up now on a truck that's designed to drop stuff off.
Yeah.
It's not as simple as just being like, let me pick that up and put it right here next to it. You don't have a fork anymore. You don't have all this other stuff.
You don't, and that's part of it, right? I mean, when you start getting into these larger items, you got a liftgate pickup now at a resident. That's not cool.
No, it's not cool.
Not really that cool at all.
It's extremely expensive. It costs more than it does to have the product.
It is, and then the issue with the warehousing as well, it then becomes when it's coming through, and I saw this firsthand at a home, online shopping, is the irregular shaped return packaging makes it very inefficient to go through a warehouse.
Yeah.
It's not in the same packaging. It's not packaged well. It can be damaged in that warehouse. You've got to have It's almost as if you have to be more aware and have better tech on the reverse than the forward facing, almost, because there's a huge potential for loss there if you don't concentrate on that.
There's just not as much efficiency for sure.
Not as much efficiency for sure. But Mr. Efficient, Nick Austin, is with us to give us the weather. Nick, how are you doing today, sir?
I'm doing good, guys. Hope everyone out there is doing great. Thanks for the compliment. I appreciate that. Hey. The weather is so quiet across the lower 48 states today. It's just unbelievable. I mean, there's hardly any rain or snow anywhere. Freight flows are probably moving really well just about everywhere. So that's really good news. I'll have a little bit more on kind of the extended forecast through the rest of the week coming up later. But we'll go to Sonar Critical Events. We'll look at the radar anyway. There's just a few little spots of rain up in the Pacific Northwest, a few little spots of snow up in New England, but that's about it. The main issue for drivers, and this is for the second day in a row now, will be across Southern California because of the winds. There have been really strong Santa Ana winds across Los Angeles, metro area up to Santa Barbara, and then southward towards San Diego. That started really late in the weekend and through yesterday. And again, in the mountains and the inland valleys, we're talking about wind gusts the rest of the day and even into part of the evening at 50 to 70 miles per hour. That's really strong. High risk for rollovers out there for drivers, especially if they're even thinking about deadheading or if they're carrying light loads, and it's going to be really risky. Even along the coastal areas, the gusts could get up to anywhere from 40 to 45 miles per hour from Los Angeles down here to San Diego. But this is just a small region of the country, but it's affecting a couple of really busy freight markets. That's the thing. So Los Angeles and Ontario freight markets are going to see some of these winds, and they're really up there as far as the outbound tender volume. So there could be a lot of truckers heading into those areas. But the rest of the country is looking quiet. There's really not much else to talk about, which is pretty rare. I mean, there's usually at least one, winter-like storm out there somewhere, and there could be rain and snow heading to a few regions of the country later this week. But I don't think we'll see anything that's going to be causing any major disruptions out there. So no major snow or ice storms, I don't think. We'll talk a little bit more about that later in the show, as well as the next installment, which is up on the website, of America's Most Dangerous Roads for Truckers. This time it focuses all on interstates, 4 interstate sections that drivers said they absolutely try and avoid when they can, and they hate having to use them when they can. So we'll talk a little bit about that later on.
Excellent. Thanks, Dick.
How about Donner Pass is on there?
Those winds out there, it's hard to play golf.
Yeah. Well, you normally think about the winds for the plains, not for California. And I'm surprised we haven't heard about more rollover incidents out there in the West Coast this year.
Yeah, exactly. No doubt. So what do we got going on in the freight markets today there, Zach?
Yeah, so
Sonar,
our outbound tender rejection index, kind of our proxy for measuring capacity in the United States. The higher the number gets, the higher spot rates go, the tighter the market is, the harder it is for shippers to get, carriers to cover their freight. It's come back down. We're back down around 25% right now. Mm-hmm. And that's down from an annual high of about 28.09%. So we came down again. We knew this was going to happen.
Falling off a cliff.
Yeah, not a surprise. After
capacity
Thanksgiving,
everywhere.
Yeah, after Thanksgiving, capacity tends to come back online a little bit, making it a little bit easier to find somebody to haul your freight. But we don't anticipate it to last very long. Looking at the charts. You can see year over year that things actually start every single year, regardless of the year. 2019, 2018, the trend is for capacity to once again get tighter, which we expect to happen here in the next week or two.
No.
Yeah.
Christmas is going to happen again this year.
COVID did not cancel Christmas.
It did not. So you're looking at, we're already at what's dry van, 307 a mile?
Well, depending on who you're looking at, we're right around $3 a mile.
Right. You expect more?
Yeah, it's going to get a little bit tighter, obviously. The real question, I think, is what does it have? When does it start to kind of ease up a little bit?
Yeah.
I think everybody's in. It doesn't take an expert to see that we're going to get tighter with people taking holidays and vacations around Christmas.
Of course. I think it's more what's going to happen after that. When you look at like the ocean markets and the air cargo, everybody's looking at past Chinese New Year before things start to even consider softening. Is it the same in surface?
Yeah, specifically. I mean, and that's the hard part, is how does this translate into surface? Right now, we're seeing this real tight connection between maritime and surface transportation. We've still got rail volumes, growing. They're still strong. The domestic loadeds, the internationals have come back a little bit week over week, but it typically takes them a little bit longer to get going again. But right now, we have service driving a lot of that.
Yeah.
And service kind of goes away in January. People don't, how long is this need for, goods and to come to their houses, to get to, how much are people still going to go to Home Depot in January? And the real factor here is going to be how quickly does that, industrial side start to kick in, because that's really what floats the freight market through the colder months too.
Yeah, I would imagine that the deep winter months, the January, the February, are kind of the lull at Home Depots and at those home improvement stores. But this year we get COVID's up, people's
people are still in their houses.
We get a stimulus package in January or February. You got a lot of new cabinets going in houses, I would think.
And we still have a strong housing market.
Mm-hmm.
Anthony Smith will tell us about that. But, there's still a lot of people buying houses. We got low interest rates spurring that demand. And it's not just about buying houses. It's not about wood and lumber and insulation and things like that, but also the items that go into those houses that drive a lot of that freight demand. And there's still a backlog. So people are still waiting on their furniture that they've ordered. So I do think that we're going to see demand levels sustained through the holidays into January, as people are just getting all the freight that they ordered back in October and November. I mean, if you go online right now and you look at anything on Amazon that's large, or Wayfair, or any of those bigger retailers, you're looking at 6 to 8 weeks at a minimum for most of that freight. And that's what's going to propel us forward. And then again, now you're going to have drivers coming off the road. Everybody takes vacations. The single most vacationed week of the year is the week between Christmas and New Year's, and that's right. In the United States, that's drivers too, and it's because traditionally we've been ingrained with this thought that there's just not a lot going on between Christmas and New Year's. Well, this year there's just going to be stuff piling up.
Yeah, absolutely. There is. You're absolutely right. But once we get past this and closer to Christmas and into January, past it, you would think that the aloha, or the average length of haul, would start to come down, right? Because there's less demand to get it across the country and let it go through its normal channels, you think? Or
traditionally, there's a little bit of an increase in aloha right around that period of time, because you have a lot of replenishment orders.
Yeah, a lot of replenishment. Yeah.
So that's that freight that moves from like Los Angeles up back into Columbus and Allentown, et cetera. You have a lot of freight, and they're also pre-ordering a bunch of freight, to get them ready for that Chinese New Year period.
For Chinese New Year, they're building up that stockpile, and then it starts to shrink.
Then
after
it shrinks
that.
significantly as you get a lot more of that DC to fulfillment center or end user type freight.
That makes sense. That makes sense. So Rhonda Bumpensa Zimmerman, it's very difficult for me to get that name out, but Rhonda says, exactly, Michael Vincent. Don't know what she's responding to, but you're spot on, Rhonda. I'm always straight on point. So I'm just going to save that and use it for anything that I say for the remainder of the show.
Yeah, I think
Rhonda says exactly. I'm right there.
I mean,
but Stephen Krenig responding to the return shipments, right? The reverse logistics. All they need to do is retrofit these malls as the shift to online shopping increases, and they shut down. I don't necessarily disagree with what he's saying there.
Strong thought.
It absolutely is. It absolutely is. Anyways, Nico Brown, hello. Sorry I'm late. And Nico Brown has a hall pass from Rhonda, so he's good to go. He's excused. And who we have right now is Mr. Anthony Smith, our lead economist. And what's going on there, Anthony? What's happening in the economy?
All happening, Michael Vincent, and you're always exactly spot on. And Zach Strickland is speaking my language when talking about construction and housing. But lately, the thing that we're going to go over, the latest number for unemployment, the unemployment rate was down to 6.7%. So a slight dip compared to that 6.9%, not exactly a huge gain in jobs, just over 240,000, I believe, added in the overall month. But some jobs added overall. When we're looking at it, there was definitely some positivity for warehousing and transportation. I think that's definitely going to be a trend, especially as we see warehouse capacity being tightened and a lot more utilization. I'm sure that is not going to be a trend that is sure to subside at any time soon. We're definitely going to see a lot more activity and employment around warehousing and transportation surely.
Yeah, do you think that any of the transition, do you think this is actually going to kind of siphon some employment away or lure some people away from over-the-road trucking or anything like that, Anthony? Or do you think that that's going to be of a different pool?
I think it might pull from a different pool of individuals, especially as we look at some of the permanent or long-term job loss that's happened since the onset of COVID-19. With that, we've had a lot of individuals that still haven't really been able to return to work, or just been a mismatch in general for local or regional mandates compared to federal mandates. When we're looking at especially the services industry for restaurant workers, there's been a lot of discrepancies on where and how different operations should operate. And so with that, there are a lot of individuals that are just kind of falling in between the cracks. So I think the transportation and warehousing industry is going to be definitely able to capture a lot of individuals that haven't been able to kind of go back to work. But with that said, when we think about these employment opportunities, I always kind of glance over, this means less consumers being able to make purchases, but it also means that, I think you touched on this not too long ago, this is going to make a strain on the supply chain when we're looking at those individuals that are not able to work, whether it be within manufacturing, and those jobs kind of really being put on pause, whether due to COVID outbreaks and having to quarantine for 14 days. A lot of that's going to put a lot of strain on some of those factories, whether it be within the service side for restaurant workers, hotel, hospitality, or within manufacturing. That's also going to just kind of put a strain on the overall workforce and supply chain.
Yeah, I don't know. I think the big question is, with these service industry workers being offline here for so long and without a stimulus package, I don't think we fully recognize the impact to the economy as they've been kind of out of pocket for a while. Am I wrong in this, Anthony? But people's actually are showing to be almost flourishing overall. Is that right?
I think when we're looking at it, it's definitely going to be a tale of two consumers, those that have been able to retain employment over the last few months and those that have been really devastated by this whole pandemic this year. So I think we're looking at those that have been able to, of course, retain their employment, feel good about their job security. They're out there taking advantage of all these purchases, and this has actually introduced a lot of individuals into a whole new world. I think Mike Vincent was telling us not too long ago that his wife isn't going to ever return to traditional shopping, and that she's always going to go through the delivery services now. And I think that's going to be the story for a lot of individuals, and that's going to increase a lot of transportation for volume, whether it be for groceries, not so much transportation on that one, but for just goods and e-com overall. I think a lot of individuals were pushed into that realm, and they're not turning back just because they see the convenience of it all. But when we have those other sides, the individuals that have not been able to return to work, and this is also another point that I'm not exactly 100% sold on this jobs report. I mean, in the past, we've seen misclassifications of individuals that have been temporarily laid off, classified as unemployed, when they should have not been really put in that classification at all, and vice versa. So not completely sold on the accuracy of the report. I'm sure there's going to be some kinds of revisions here as we move forward, just telling us how many individuals are actually unemployed or just temporarily laid off.
So you said it was down to 6.7% was the unemployment, and did you say that warehousing and transportation both did well as in the unemployment as well?
That's right. Transportation and warehousing did really well, and that's definitely an area that I see really being supported with a lot of the new trends that are happening right now, and it's likely to push forward into 2021 as we see a lot more individuals or a lot more companies looking to get closer to that final consumer and really ramp up, I think, some of their supply chain goals on getting close to that final consumer and really pushing that e-commerce way of life.
Yeah, my thought there, Zach and Anthony, either one of you is so do we see these, like you mentioned, these service industry people, restaurants, et cetera, that have been out of work and not coming back and now gone again because there's shutdowns happening in different places, right? Are they transitioning into warehousing and stuff? Are we starting to see that happen with unemployment start to go down a little bit?
I mean, that's an Anthony question for sure. I don't know. I haven't seen any data on that. Have you seen any stats on people changing industries, Anthony?
I haven't seen there hasn't been a lot of data out, but as I mentioned earlier, I think it's a lot more likely that we've seen some of those service side individuals transferring into some of things like warehousing, things like that, compared to over the road transfers into that area. So I think definitely when we look at those that are just in need of employment and able to work, I think warehousing, I mean, we're looking at places like Amazon, UPS, FedEx, all really kind of still hiring at a pretty decent clip just to kind of stay on pace with, a lot of the demand that's really happening right now within some of these volumes that's happening within warehousing and this supply chain logistics. So I think the transportation industry is only going to keep and continue to grow when we're looking at that standpoint. The other aspect is, of course, within other hot areas like construction, there's been some growth in the last month of employment in that area, but still a lot of demand in that realm, in that industry as well. A lot of shortage of labor, just kind of trying to keep on in pace with the demand that's happening throughout the country.
Excellent. Thank you so much, Anthony. You have a great day, my friend.
Yeah, the construction's kind of the area that everybody traditionally thinks takes drivers away from the pool. I haven't really seen any hard stats or data on that, though.
No, we'd experienced it in a former life where at certain times of the year we lost drivers to the highway construction, et cetera, right? Through the different seasons, that fluctuation between winter and construction season in the Northeast. Right? Yeah. You got winter and highway construction.
But I would like to see that represented in some form of data.
Yeah, it would be interesting to see that, those switching of gears and who's stealing from who and where those pressures are. Right?
Yeah.
So C.R. Burns, CEO at C&M Innovators, LLC, new to the show, says, hey, just ran across the site. I love it. And welcome, C.R. Burns. Yeah. Keep watching. You'll learn a lot and get your comments in here. I see the rest of the community welcoming C.R. Burns to this. And speaking of welcoming, we got Kyle Lintner from K-Ratio on the line right now with us.
Yeah,
Kyle, how are you today, sir?
Doing well, guys. How are you? I haven't seen you in a bit.
I know it has been a while.
How are things in sunny Chicago?
Oh, just glorious. Every day it's 80 and sunny. It's lovely. To be honest, I think it's 30. I haven't seen the sun in a few weeks.
So you're not part of like the Polar Bear Club there? You're not going to go jump in Lake Michigan in your Speedo or anything like that?
No, I'll pass. Thank you.
Excellent. Hey, Kyle, thanks for coming on the show here. Let's get to that, start talking about some interesting things going on in the freight market. But tell people a little bit about your background in K-Ratio to start us off here.
Sure. K-Ratio is a risk mitigation advisory firm in Chicago. We specialize in maintaining expenses and revenues for any company inside of freight, be it shipper, carrier, or 3PL. Specifically, I think I've become known for a market-based approach and thoughts around the industry as a whole from a market point of view.
Yeah, that's...
I'll leave it at that.
Yeah, concise and to the point. I like it.
I love it.
So, Kyle, you've obviously had a lot of experience with the trucking spot market, and we have seen some pretty astronomical rates this year. How do you think that this plays out for the rest of the year? Do you think that we're going to level out? Do you think we're going to start shooting back up again? What are you seeing?
There is an inherent bias to the upside on this, and it persists at least through the end of the year, probably through Q1. And I'll tell you in a concise manner again, because people have asked. All right, we see tender volumes pull back, we see tender rejections pull back. Why is it rates are still going higher? And it's because of the unique situation we have in freight, where there is spot and contract. And right now, that relationship is inverted. In a healthy freight market, you want contract above spot. To be honest, that's how a 3PL can compete with a carrier and provide service to a large shipper. When we see it flip like this, every single 3PL is now underwater on any contract business. The only way they're making any money is on spot. And the spread between those two on average is widening. It's now out to its widest mark as reported by DAT. Contract rates alone jumped 4 cents from last month. So I think of that as like the floor in spot prices. And as long as the floor keeps moving higher and higher, anytime there is a load that has to go spot, it's going to be done at a higher and higher price. It won't be until we get a great reset in spot price or in contract prices higher that relationship will stop. Thankfully, in freight, we have this annual RFP process, but that's still a few months away for the most part. So until that happens, we're going to be living out the situation of any load that has to go spot is going to go at a much, much higher rate than contract.
So you've got this kind of inherent nature in the relationship, as you're pointing out, much like erroneously steering a boat, or the first time you've ever been on a boat, right? Oh, I'm going this way, I want to go there, and you way oversteer, right? With these corrections, the flip-flopping of contract over spot or spot over contract. Is that built in because of the yearly contracted cycle that we have, the yearly bid cycle, and should that be reduced or maybe done in a slightly different manner to prevent that?
Yeah, we could probably talk for 6 hours straight about what should change. We gloss over that one, but you're 100% right. That's part of the problem right now is the way that the freight market is set up. We have these contract rates, but nobody really has to stick to them. And we can go spot because of that. We have a starting point for price contract, but it doesn't end up there. And I don't think this changes from this current setup until that relationship does flip. And that's because we've lived through, just think past in the last 3 years, 18, great for the spot market and anybody playing in it, terrible for a shipper. Obviously, we have a reset in 2019. It gets pushed to the extreme other side of the boat. And now we come out in 2020 where it feels like we've experienced every single cycle of business in a few months. So the flopping back and forth is what keeps this thing volatile. And when you have now a positioning and a setup inside of the market where capacity is scarce, that price is always going to continue to drift higher until it changes. Change comes incrementally or all at once. We had the all at once part, and now the incremental is just going to be a continuation of pushing the price higher and higher and higher, because at the end of the day, this market's no different than any other market. Price is simply an advertising mechanism, and all that is saying right now is, I need a truck really effing bad in this market. I'm willing to pay this much for it.
Yeah, I like that. So from a brokerage standpoint, you've taken a bath this year to an extent on the contracted side. What would be your advice, or what would be your strategy moving into 2021 in terms of how you're going to set that contracted rate? Are you going to take more than maybe you would on the contracted side just to make sure that you adhere to that? Are you going to divert more capacity to the spot market? Are you going to rely on more of that spot market revenue in 2021? Any thoughts?
Yeah, lots of them. There's probably no right answer or no wrong answer because the future is so unknown. But I think obviously the first quick answer to that is a healthy balance between the two, because you don't want to be one or the other. Otherwise, you have feast or famine with your balance sheet, and that's not good for anyone. But to give you just my personal opinion on it, I think when we get into 2021, there is so much inventory rebuild that needs to happen. You can erase Q1 and probably Q2 if we start to think about the typical seasonality in freight, Memorial Day, the June build up. Now we're at the second half of 2021. Coincidentally, or maybe not coincidentally, we now have Class 8 orders, the highest that they've been in quite some time. That's not going to show up till Q3. So we have some seasonality where there's a downturn. We have more capacity coming onto the network. I think that's probably the spot where a lot of the country returns to normalcy as well. So now, if we think about it, if everything else is starting to get back to normal conditions, rates should do the same as well. If I have to run an RFP, I'm probably thinking about this as the tale of two halves and how I want to set up between the two. Maybe I take it on the chin for the first half, or I keep it super, super competitive, knowing that spot rates are going to drop in H2, and that's where I'm going to make my money. My margins are going to go beyond the average at that point, more so on the tightness I had on my margins for the first half.
So, Kyle, I'm interested. There's a number of different brokers coming out with this. What are they calling it? Guaranteed premium, I think it is, where they're guaranteeing a specific
guaranteed rates.
Yeah, there's almost it's a guaranteed margin,
right?
More than it is rates, and then the transparency afterwards to show the shippers, their customers, how well they did for them as far as saving them money, and really not like a contracted flat rate, right? To guarantee capacity in those things. What do you think about that method as far as trying to secure capacity?
I love the sound of it. I don't know how it works. in theory, everything works. In application, it's another story. Transparency is great for every single person involved. I think the number one question to answer on that, what's the transparent rate that's given? Where is that being sourced and how? Because at the end of the day, if we can all agree to an open, transparent marketplace with prices, then we can have that situation like you're talking about. We can provide you a flat margin with a guaranteed level of service. And that's really what everybody wants. Now we can compete on how our organization provides service to you, and the shipper can decide if they're happy with that, instead of this murky world of, I don't know what a rate really is, or am I getting charged a good one? Are they putting me a premium on top of a bad rate? Without knowing the starting point of what the real price of a lane is, you can't even have the conversation.
Right.
Yeah, I think that's actually a really good starting point. Like we have these discussions all the time internally about what is the right rate for a lane. And obviously in your world, you've experienced several right rates, and the answer is whatever rate works for that lane in that day.
Yeah, it depends on who's. Well, yeah, we have the old adage, the stupidest person in the room sets the rate, and that really can go, or the most desperate, I suppose, is maybe a little bit more accurate. But when times are tough and capacity is abundant, the rates just go down because someone's always willing to undercut you.
Right.
A few cents a mile.
Yeah, and
in this day, somebody's always willing to pay a few cents more to get that freight moving. So,
I think the problem is that you have this disconnection between cost and the rate when we get in a market like this, and there's not a lot of availability or transparency in the market, as you said, Kyle, that allows you to have any insight.
Yeah, and if we can get that, think about this for a second. Let's say we get a daily published rate that's accepted as it. And all of the things that you guys are alluding to with that makes a load unique, that pushes that price up or down, that can be factored into it. If I tender over on a weekend, if I tender after 4 p.m., we have automatic kickers that we can build on top of that average price of that lane for that day. Now, how far you deviate from that average price is going to be dependent on how well your business is operating, thinking from the 3PL space. So if I can consistently purchase under what that average price is, I'm running my business better than my competitor who's continuously paying over that price. That's the way a free open market is supposed to work. We're supposed to reward companies that succeed and run better than the lower performing companies. And some of those lower performing companies end up going extinct. And that's better for the marketplace overall. We clear out those that cannot do in an optimal way what another company can. But we can't have any of that occur until we first get that daily price out of the way.
Excellent stuff, Kyle. I appreciate that. We're out of time. Lots of positive feedback in the comments. Wow, this was a great discussion from C.R. Burns, one of our newest people here, and several others. Excellent. Thank you for the information. Great information, Kyle, from Rhonda, Bambenza, Zimmerman, etc. So, Kyle, how do people reach out to you if they want to learn more, or continue the discussion, or get involved and find out what K-Ratio is doing?
Easiest way to do it is k-ratio.com.
There you go.
And there you have it. Again, another concise statement from
Mr. Concise. Thanks, Kyle. Take it easy, my friend.
Thank you, guys.
Yeah, good discussion. We could go on forever. I know. Especially the three of us.
Yeah. Well, we have before.
We have many times. That is, it's not.
I'm surprised they didn't come out and cut us off.
They started getting worried. We're a little bit over time there. But you know who we have next?
Greg Miller.
Yeah, I was hoping you did because I forgot. No, I'm just kidding. So, Greg, how you doing, my friend?
Good. How are you?
You're doing great. Greg Miller is a senior editor at FreightWaves, carrying maritime, correct?
Absolutely. And as always, there's a lot going on in maritime, particularly the Trans-Pacific. It's still crazy out there. Nothing has let up.
Yeah,
let's talk about
your Christmas tree, which is extremely lit up and well done.
Thank you very much. 'Tis the season. The Trans-Pacific. So everyone thought that in October after Golden Week, things would slow down, and it never has. And the Port of Los Angeles has a data set called the Signal, where they show you using manifest data, the cargoes, the TEUs coming in this week, next week, and the week after that. And if you look at the numbers as of today, for December, there's no let up. The numbers in December are as high as they were in November. Also today, Hapag-Lloyd came out and adjusted their guidance for the fourth quarter. demand is better than they even thought it was. And if you look at AIS data, the ship positioning data, you see every day about 30 container ships in the terminals in LALB, and you see over 20 ships sitting out there in the parking lot of San Pedro Bay. So there's a huge pileup, and so 2020 is in the bag. Nothing is going to let up this year.
Yeah. So how does that bode for the buildup to Chinese New Year's? If we've already got this buildup right here, is there any of that out there where people are actually looking forward to and looking at these cycle times, thinking I've got to start building up now for that to get it on a ship that's maybe only 40th in line to get into the port, or what?
No, absolutely. Just like I say, December's in the bag, January's in the bag as well. As we know, before Chinese New Year every year, you're going to have a surge, and everyone is expecting January to be better than December. And if you think about it, if you're taking a cargo from China to New York through the canal, it's already in the Pacific right now. So that's already locked and loaded. We can assume that January is also done. And then Chinese New Year this year is February 11th to the 26th. And then it bounces back after that. So pretty much everyone's now looking at March. Even in the worst case scenario of some sort of cataclysmic drop in cargo demand, it's not going to happen before March. So we're all the way into the first half of next year.
Yeah, that's tremendous, considering that we've already seen, probably. Have you ever seen anything like this on the maritime side?
No, I don't think anyone has seen anything like this. And the real concern for shippers is that, as you know, the annual ocean contracts are renegotiated in the first half, and no one really thought the spot market strength would extend all the way into the contract negotiating season. And if it continues like this, then the shippers are going to have a much weaker hand at the table in the first half of next year, and that's a real problem in terms of their costs.
Yeah, and spot rates jumped on the Trans-Pacific routes. Like they were like 1,300 in April, and correct me if I'm wrong, but now they're over 4,000, 4,500. Is that accurate?
Yeah, they're about 4,000. They went up to 4,000 and stopped, not coincidentally after the Chinese government said, "Don't let them go any higher." And it's not just California. It's also the East Coast and the Panama Canal. And one of the other things that we covered in the last week was a huge situation going on right now in the Panama Canal. Things are getting very tied up, and they've been tied up since October. And there's a couple of reasons for that. First off, you have the container flows, as we've talked about. You have LNG cargoes coming from the U.S. Gulf to Asia for power. And you have LPG cargoes, which is propane, going from the U.S. Gulf over to Asia, which is for heating, cooking, and something called a PDH plant, which is a propane dehydrogenation. They create propylene, which becomes polypropylene, which becomes plastic, which we all. And one of the things about the lockdown is that we're using a lot more goods with plastic wrappings and containers. So plastic demand is up too. So all of these things that are happening for COVID are having these effects on ocean shipping demand in various ways. And so all of these ships are converging on the canal at the same time. You also have weather issues with fog, and you also have reportedly some COVID restriction issues with some of the personnel there. So there's a lot of delays. Big situation down there.
Wow. Now, we only have a little bit of time left, though, Greg, but I did want to get into the conversation a little bit because this is really interesting to me. You were trying to sell me on flexi tank wine, and you were talking to, I think you had an interview with the CEO of FlexiTank, and you were trying to convince me that wine from a FlexiTank is not swill. Is that correct?
It is not swill. We drink about a case of it a week here in my household. It's good wine, and so, but essentially, what the basis of the interview was that flexi tank wine, which is the basic wine you get in a grocery store or a liquor store, not in a restaurant or hotel, has gone through the roof this year. It's gone up 30% year on year during the lockdowns, and I did some quick back of the envelope math. Each flexi tank has the equivalent of 32,000 bottles of wine in it. It goes into a 20-foot container. So if there's about 300,000 flexi tanks to be shipped this year, up 30%, That means the year-on-year increase was 29,230 flexi tanks. Multiply that out by 32,000 bottles, I get 935 million, close to 1 billion more bottles of flexi tank wine, i.e. wine you drink at home, was consumed around the world in 2020, courtesy of COVID.
Wow.
Wait, so what is a flexi tank?
A flexi tank is a flexible bladder polyurethane, multiple layers, and you basically put it inside a 20-foot, generally a 20-foot container because of weight issues. You fill it up with wine or olive oil or fish oil or soy oil or industrial oils, and then it's a one use. So when you fill it up, you ship it across the ocean, and then you unload it, and then you dispose of the flexi tank. Hopefully, you recycle it. So the advantage is if you put a 20-foot container with bottles, you get 9,000 liters of wine per TEU. With a flexi tank, you get 26,000 liters. So you can get much, much more volume. And so, you'd be surprised at, you can look at the back of any bottle of wine that you have, and if it's a French wine and it does not say bottled in France, then you are drinking flexi tank wine. It came from France and was bottled in New Jersey or something. It has.
Wow.
Look at the back of your bottle and you'll see it.
I get the volume. I get the volume. The advantage of the volume. Replacing the packaging with actual product. I get that. But why is it advantageous over a tank, over a tanker?
Well, the actual the tank containers are much more expensive.
Okay.
You actually have to reposition those things. It's 3 times as expensive. They're only used for a hard liquor. Whereas a flexi tank, you throw it out. You don't have to worry about repositioning costs or any of that stuff.
It's either easier to repurpose the container once it reaches destination, and the flexi tank, you can use it for dry goods or whatever you have, and it's not just liquid. I get it.
And I would assume there's some spoilage issues as well. Yeah.
Spoilage.
Yeah.
Yeah. Well, I mean, you break one bottle in a flexi tank, you're done.
You're done.
That is great stuff, Greg. Hey, we have to move on, my friend. It was excellent stuff, and 1 billion bottles of wine, and what about 200,000 that? Thanks to the Miller household there. Hey, Greg, how do people reach out to you and read your stuff, man? It's excellent.
I appreciate it. It's gmiller@freightwaves.com.
Thank you so much, my friend. Love your Christmas tea.
All
Have
right.
a good holiday.
Thanks, Greg.
1 billion.
That's a lot. That's a
It's
lot
a
of
heck
wine.
of a tailgate up there.
I'm gonna get a flexi tank for my house. I'm gonna import that thing, set it right next to the garage, and set myself up.
Excellent.
Next lockdown, flexi tank at my house.
Excellent move. Excellent move. How about you, Nick Austin? You got a flexi tank there at your house?
Not yet. Hey, maybe someday. You never know.
You
I
never
hadn't thought
know.
about it before, but thanks for the idea. So I want to give a quick shout out, though, before we talk about the weather once again. Nico Brown, he's one of our regular viewers, and he's up there in Virginia, just outside of D.C., where he simply says it's cold. So Nico, try and stay warm. Do the best you can. It's kind of chilly down here in Chattanooga, too, and other parts of the South. Out west in California, still dealing with a lot of high winds for the rest of today. Out in Southern California, so high risk of rollovers there. But I don't think we're going to see any major snow or ice storms for the next several days, which is really good news for drivers out there. There will be some rain and snow here and there from the Southern Rockies, and then later in the weekend, during the weekend rather, up towards the Midwest, maybe some parts of the Northeast, but probably nothing that drivers can't handle. I don't think it's going to stop them in their tracks. But there are some interstate sections that they really, really don't like, from what some drivers told me. And there's an article on our website, FreightWaves.com. It's the 3rd installment of America's Most Dangerous Roads for Truckers. One of them is I-80 in Wyoming. You guys would probably agree with that. I've probably heard from drivers about that one, particularly southeastern Wyoming. They get wind gusts out there that are just outrageous, even on sunny days. I mean, you don't even have to have snow on the ground, which just makes it worse. But also I-80 through Joliet, Illinois. The twin bridges that go over the Des Plaines River. I hope I pronounced that correctly. But that's also a trouble spot that they mentioned. as well as I-70 through Colorado, through a lot of the Rockies out there, especially west of Denver, the Eisenhower Tunnel, just areas like that. So there's a lot more detail. A fun and interesting read, though, especially maybe for new drivers out there, drivers that have never had to drive through those areas. Maybe they'll have to someday, so go check that out.
Yeah, I've driven. I rode over 2 of those this year, in the past year. So that's actually really interesting stuff. Good stuff, Nick Austin.
Thanks, Nick. Nick Austin, guaranteeing you a white Christmas this year.
Yeah, that I didn't think about it, but I just thought the Twin Bridges was a pain for me on the car. That's a terrible.
It's a pain for everybody.
Yeah,
found out,
it
right?
sucks for everyone.
Yeah.
And of course, we were up in the Rockies in February before COVID.
Oh, very cool.
And yeah, they asked me if I wanted the 4-wheel drive vehicle. I was like, no,
I got this. For Tennessee.
Of course, I get over the top of the front range there, and just over the top of the Continental Divide, and all of a sudden it's just white.
Yeah. He's like, whoops.
I was like, this is nerve-wracking.
Yeah. Oops.
My body temperature increased about 10 degrees.
Yeah. Oops. Hey, you know what's coming up? The North American Supply Chain Summit is coming up on December 15th, my friend.
Next Tuesday.
It is next Tuesday. So, entering 2020, there was enormous uncertainty facing supply chains, whether it was geopolitical developments such as Brexit and the U.S.-China trade wars. Remember back in the good old days when Trump was trying to start World War III when things were normal?
Yeah.
Yeah, right? Yeah, trade agreements like USMCA, import-export restrictions, were all the things we had to worry about, and it was still crazy. Well, there's so much more to worry about and so many more things that are happening. Tune in on the 15th for the Supply Chain Summit. It's going to be excellent. Partake in the North American Supply Chain Summit there and get ahead of what's going to happen over next year and hear from the industry leaders.
Yeah, no, and there's been a lot of activity in the supply chain this year.
There has.
I mean, a little bit.
Just a tad, right? Things are changing. Hey, you know what? Yesterday on What the Truck, we talked about a whole bunch of stuff. Vaccine distribution and the possibility of counterfeiting there, right? Which is hard to believe, but somebody's trying to do it.
I mean,
right?
Wow, people! Wow.
Yeah, I mean, well, we didn't have any specific things, but it's there. And be careful. Look at it. If it's spelled with a K, it's probably not the right one. But and then drayage, congestion, etc. And we talked about it in truck platooning.
Yeah.
Right, with a driver and an assisted vehicle in the front.
Still talking
and then
about that?
Yeah. Oh, yeah. We were talking about that yesterday. It is excellent stuff. But one of the things on COVID protocol was Taiwan.
Yeah.
Which I thought was interesting. I'd like to get your take on this really quick. So Taiwan, 23 million people on the island, right? 726 cases. That's it. 7 deaths. That's all. But you know why? Because if you test positive, they started basically on Christmas Eve last year. As soon as they heard that there was maybe this possibility of something happening in Wuhan, they started screening people immediately that were coming in. You test positive, you're put in a hotel.
Yeah.
You know what happens when you step outside your room for 8 seconds just into the hallway and not even talk to anybody? $3,500 fine.
Wow.
They put you in a hotel room, you're there. $3,500 fine. Guy walked out of his room, was caught on TV for 8 seconds outside his room, not even talking to anybody. $3,500.
Yeah, I mean that's. But Taiwan is an island, a tiny little island. I mean, one of them gets it, it's over. Like if they're interacting with the rest of the, if you've looked at anything about how viruses spread, you have to do it that way if you want to prevent it.
Yeah, exactly. Yeah. It was so the discussion we were having with Dooner and some other people was basically, how do you handle it? So all the other people that are affected, like say how we handle it here in the United States, they're not being affected that way in Taiwan.
No.
The people who get it, they're inconvenienced for a couple of weeks and they're stuck in this room and hopefully they're given some type of, game, a PS5 or something to pass the time. $3,500 fine because we're serious if you even think about leaving the room.
Yeah.
But think about all the service industry and stuff, people that are still working.
Yeah. Well,
because of those strict.
But think about the gateways that they can control. But, we have a huge geography. This has been common thing that we've debated on numerous shows, Freightonomics, even one of them, where, you talk about, South Korea, they have a much smaller points of entry. You know,
they absolutely
Taiwan's
do.
no different.
And the slippery slope of giving the government the ability to have that type of control is difficult,
especially in our society.
Yeah, absolutely. But hey, you can find all the FreightWaves shows on demand on FreightWaves TV app or on your favorite podcast player. Simply subscribe to Freightcast and get every single FreightWaves podcast all in one feed. That feed is also an exclusive audio home to the Midday Market Update. Have a great day.